Hello, winning investor nation. Ian and Amber here with your weekly Monday Market Insights webinar, your home of the latest on the markets, crypto, and growth stock megatrends. Thank you so much for tuning in this week. Please remember to give us a thumbs up if you like the content of these videos and smash that subscribe button and click that bell so you're alerted immediately when new videos are posted. So good to see you, Ian. Good morning. How are you? I hope you had a nice weekend.
I'm doing well, Amber. Happy Monday. I'm excited to get going on this webinar today.
Oh, yes. Happy Monday to you too. So, everyone, as a recap, where inflation monitoring is concerned, last week was a big week for economic releases. The big numbers that we were all watching were July's Consumer Price Index, CPI index month over month, and year over year releases. Surveys were expecting a slight dip or softening, and that's what happened. The numbers showed that July CPI inflation decelerated. Core CPI, which is the print that the Fed really monitors that excludes food and energy, actually came in below forecasts. So this is a possible positive trend. Stocks moved higher on this data, rallying about 2.5% over the past week. And keeping an eye on Brent oil futures, they're holding steady around $93 a barrel, down from a recent high of 106.50 on July 25th. Now, Ian, we're always on the lookout for indicators that forecast elevated inflation and future price trends while eventually showing declines. And one of the main elements to watch are retail inventories that we're finding. Consumer spending actually has shifted in recent months to services. Major retailers are, we can say, facing an oversupply of products in their warehouses, coupled with a low consumer demand environment. So this can spell price discounts going forward. So one example is Samsung. Samsung is reportedly stuck with 50 million unsold phones right now. Can you believe that? The company ramped up production, but demand was no longer there. So now apparently they have 50 million phones sitting in their warehouses unsold, and supply is also outweighing demand at Walmart, at Gap, at Target, as well as American Eagle Outfitters. All this inventory sitting idle is prompting some retailers like Target, get this, to consider revising their return policy. Have you ever heard of that before, Ian?
No,
Isn't that crazy?
that's crazy.
That's
Yeah.
crazy.
I figure half the goods you buy at Target and especially Home Depot have been returned at some point in their lifetime.
Yes, but what they're doing now, the way they're seeing it, is that it's cheaper to refund customers like us our money
Hmm.
and let us keep the product because they don't want to pay for the return and hold this extra product in their inventory right now.
Yeah, I know that's been one of Amazon's policy for like lower dollar items for quite some time.
Yeah, so now you're seeing it in the big box
Hmm.
retailers. And there's one more interesting indicator to watch that I found this past week, Ian, and it's furniture inventory.
Hmm.
Census data is showing there's a U.S. furniture glut forming as demand falls. Wholesale sales have dropped 2.9% in June, a second straight monthly decline, and stockpiles rose 2.6%. So this spells also a possible future discounted sales price for furniture
Yeah.
due to this
Yeah.
oversupply in the future.
Yeah, and I would just note that, this is the bigger picture here is the Fed has engendered the slowdown, especially when it comes to furniture. That is correlated with new home sales. People buy new houses, they go out and buy new furniture for the house.
Mhm.
You've seen mortgage rates go from under 3%, at the beginning of this year to over 5% at their peak.
Mhm.
And that has really slowed down new home sales. And in turn, this has a ripple effect through the economy where people buy the new house and then they go out, they buy new furniture, they want to redo their wardrobes, they buy new clothes. And so it really starts with new home sales.
Mhm.
And you're really seeing it in the data with all these excess inventories that the economy is slowing because demand is slowing. And I think there's two factors of that. Number one, you have interest rates going up across the board, whether it be, mortgage rates or auto loans are more expensive now than they were because interest rates are rising. At the same time, as the stock market falls, there is a wealth effect or a negative wealth effect that's created. So people look at their portfolios, they feel less wealthy than they were last year, and so they cut their spending back and try to save more. So those are two things that are impacting the economy, and that's why a lot of economists are pointing to the fact that we're more likely than not in a recession right now.
And the way I look at it, Ian, I say, so what does this all mean for us, especially where these declining, potential declining prices we'll see as inventories increase? Well, I say there will likely be a vast oversupply of like many products for the foreseeable future. And this will possibly lead to what I would call a deflationary environment. So this is like consumer spending habits are changing because our tastes and preferences as consumers are dynamic. It's not stagnant, we change. And I think that we would want more future forward type products as our tastes change. And these companies holding on to these older inventories, coupled with their mounting debt, they will need to possibly see lower rates from the Fed, not higher, going forward to stay stable. How do you feel about that? Do you see that as a potential?
Yeah, I mean, I think it comes back to the biggest issue the markets have faced this year, and that is the rate of inflation is at a 40-year high. And when you start seeing excess inventories, that means the price of those goods is going to come down. You're already seeing prices come down all across housing. I know that automakers, which used to have a massive surcharge on new cars, they used to charge, $10,000 more, $15,000 more, depending on what car you're buying. Those charges are now going away as dealers are trying to compete for business. And in general, that is going to be good for slowing down the rate of inflation. When we have the rate of inflation slowing down, that means the Fed does not have to hike as high as we previously thought they would. And that in turn is going to be great for the market, especially in the growth stocks that are more reliant on future cash flows and keeping a lower rate of inflation down over the next couple of years. So this is good news. And as I said, I stand by my call that in June, I believe we saw the lows for the year. The news at that point was, as bad as it's going to get. Obviously, you look at the CPI, it's still running above 8%, but markets don't bottom on good news. They bottom on bad news. If you think back to the last major market bottom we had during the COVID crisis, it happened in April. At that time, COVID cases were still raging around this country. There were still lockdowns happening all around this country. But what we saw was that the rate of new COVID cases, the increase was slowing. So basically the derivative of new cases was slowing down. And that was a sign that eventually COVID was going to, taper off and the economy would come back. Same thing with inflation right now. We are still seeing a higher price level than last year, but the month-to-month change has been flat. And I think in the next couple of months, we're going to start to see the month-to-month actually start to come down as well. And then that'll give the year-over-year pace to markedly decelerate. And I think that's the kind of news, the narrative that the market and especially institutional investors are looking to hear before they wade back into the waters. Last thing I'm going to say is that we started the year off one of the worst starts of the year in 50 years. The S&P 500 was down 20%. That's a bear market. The Nasdaq was down 30%. Since then, we've recovered half of those losses in both the S&P 500 and the Nasdaq in just a month and a half. So we've seen incredible rally off the lows, and a lot of the bears, a lot of the hedge funds that have been kind of pounding this market into submission for the first part of the year are just caught off guard. And we're at a price point, I believe, an inflection point in the market where, we talked about this morning, where you have basically more than 90%, I want to pull this chart up for viewers, more than 90% of S&P 500 companies are trading above their 50-day moving average. And this is a very strong buy signal. It has been an indicator that you see higher prices 3 months, 6 months, and 1 year down the road. And this has held for the last 20 years. It just shows that there's a lot of buying power coming into the market. And if you're a hedge fund manager and you're short and you're still bearish and you're waiting for the market to roll over again, you're having second thoughts about that. And the longer that we can stay up from a technical perspective and elevated like this, the less likely that hedge fund managers are going to press their shorts, and the more confident investors are going to feel holding on to the stocks that they've held through, this storm that we had through the first half. So everything right now is looking very optimistic, very positive from both a macroeconomic perspective and also a stock market perspective. So I'm glad we could share a little bit of happy news for everyone on Monday. And look, we might have a pullback this week. I mean, the market has surged since mid-June, and it's likely that we're going to have some type of consolidation, some type of pullback, some type of back and forth. But I think for all intents and purposes, the lows for the year have been in, and I expect us to at least finish the year unchanged. The S&P 500 is still down 10%. We can have another 10% rally, another 15% rally into the Nasdaq, maybe even higher into the end of the year.
I love it. Ian, happy news, good news is what we need to hear, and especially when it's backed by solid info that you've just presented.
Thank you.
And you're welcome. And I can say that over the longer term that we could possibly see a shift toward what we can call new era products and tech innovations, just like those that are recommended in your newsletter, Ian, Strategic Fortunes, creating this type of deflationary boom per se. So I think we're in the midst of a future for positions that are just really primed for gains. And innovation is the future, right?
Absolutely. And, we've discussed when the economy has a recession, businesses look to do more with less. They try to run their businesses more efficiently. And what does that mean? It means investing in types of capital expenditures to move their businesses to the cloud, investing in artificial intelligence, changing their fleets and their workforce, if you're a logistics company, into electric vehicles, which is going to help out battery infrastructure and, electric vehicle charging infrastructure and also battery developers. So a lot of these future developments and technologies actually are helped by recessionary environments when businesses need to figure out how to run their, the companies more efficiently and cut costs. So it's all about doing more with less. That is the kind of companies that we're investing in, and we feel that our portfolio is really structured to benefit from these types of recessions where businesses are forced to do more with less.
I love it. And speaking of your portfolio and more with less and technology's efficiency, Ian's next stock recommendation, which is being revealed in his September Strategic Fortunes newsletter, is a plug, has its hands all over the innovations like Ian just mentioned. We talk about robotics, AI, EVs, and it's a pick that's not to be missed. Personally, I think it's a GOAT, the greatest of all time type pick. and it's soon to be like part of the multi-trillion-dollar new era economy. So Winning Investor Nation, if you like to be in on Ian's upcoming stock pick, which is coming into September issue, please click the bull icon. Yes, this blue bull icon right over my shoulder to get all those details and get signed up for his newsletter.
All right. And thank you for introducing that. And, I would just say that it's September already. You reminded me that the year is almost 3/4 over. It's hard to hear that, It feels like New Year's was yesterday, but another year zipping by again.
I know, Ian. So just one last thing on the economic front, for U.S. economic releases for this week, on Tuesday, August 16th at 8:30 a.m. and 9:15 a.m., we have July's housing starts and industrial production prints that will post. Surveys are showing a slight decline in housing starts and an improvement in industrial production. On Wednesday at 8:30 a.m., July retail sales, advanced month over month, will post. Surveys predict a dip there. On Thursday, a trio of reports will release. Weekly initial jobless claims, July existing home sales, and July's leading index will all post between 8:30 a.m. and 10 a.m. And surveys are showing an increase in jobless claims, a decline in existing home sales, and a slight improvement in the leading index. So stay tuned for those big releases for this week.
All right.
So Ian, we have a question that's come in. I think it goes really well with our next part of our talk is on cryptocurrencies. And we have a question that's come in from Linda. And Linda is just seeking, Ian, an update on Dogecoin. She'd like to know, what do you think about Dogecoin?
What do I think about Dogecoin? Okay, so I'm kind of partial towards Dogecoin because I do have a dog that is part Shiba Inu.
Oh, no.
And so, I'm partial to Shiba Inus first and foremost, but I want to just explain something to our viewers that might not be intimately familiar with cryptocurrencies. Now, there are different types of cryptocurrency categories, and you can think of it as number one, there are cryptocurrencies that fulfill the currency aspect that you can use instead of a currency. And that would be Bitcoin, Litecoin, Dogecoin falls into that, Bitcoin Cash. And their purpose is you can buy and sell things with them.
Sure.
There's another bucket of cryptocurrency that are called utility tokens, which allows you to build new types of digital infrastructure with them. So think about all these, decentralized finance exchanges, or anything that is in the traditional finance world that's moving to the blockchain falls under this category of utility tokens. And then lastly, there aren't the proliferation of them yet, but there will be securities tokens. And that's basically a cryptocurrency that represents ownership in a real world asset. And probably most famously is there's a couple pieces of art that had been fractionalized and represented by tokens. So they took a Banksy and they fractionalized it, and they sold $15 million worth of tokens. And every person that has one of these tokens has a piece of ownership in this famous artist Banksy's work. Mm-hmm. So those are broadly the three types of cryptocurrencies. Now, Dogecoin fulfills the currency aspect. It's a cryptocurrency you can buy and sell. And I know, Amber, you've mentioned it. Mark Cuban is an investor. You can go to a Dallas Mavericks game and you can buy things in the Mavericks game with Dogecoin. There are some gaming sites online, such as Twitch, that allow you to use Dogecoin to kind of tip the influencers on there. And so it has a little bit of real world traction. I would say there are about a dozen places that you can use Dogecoin right now. Now, from my perspective, if you want to have a currency that is widely used, you're going to need to have it accepted at more than a couple dozen retailers, right? I mean, Bitcoin has over 100,000 global merchants that accept Bitcoin payments. And it has just a huge lead on Dogecoin. Bitcoin has a huge lead on Litecoin, on Bitcoin Cash, on Bitcoin Gold. What I'm saying is there have been a number of alternative cryptocurrencies that have been created where they're actually merchants that accept it. And let me just give you, the use case for why Bitcoin is a much more viable alternative currency than any of the other ones out there. It's because to generate Bitcoin, you need to invest in a $3,000 miner, and then you have to run energy out of your house, or if you have a mining facility, to actually mine cryptocurrencies. And so what Bitcoin famously did is it converted a capital expenditure of a computer and also electricity to create security for the Bitcoin network. And so that is why you could say Bitcoin has real world value, because to obtain it, there was what they call proof of work. You had to do some type of work to receive it. A lot of other cryptocurrencies have just kind of appeared out of thin air, right? They were pre-mined, they were distributed to major holders, or some major holders kind of knew that this was going to be a big cryptocurrency in the future and were able to make a bigger CapEx expenditure in the beginning on miners and whatnot. The thing that I always look for is, number one, is there real world adoption? With Bitcoin, you have hundreds of thousands of merchants. You have institutions that are saying, this is now a store of value. I mean, you have BlackRock, which has $9 trillion under management, which recently did a joint venture with Coinbase to allow people on the BlackRock platforms to invest directly into cryptocurrencies using Coinbase's custody. A lot of that institutional money is not moving into some random cryptocurrency. It's going to move into Bitcoin and Ethereum. The other thing about cryptos is that you can prove the value of something if it has real world utility. So think about layer ones like Ethereum, Solana, Avalanche, Tezos even. These cryptocurrencies, you can build things with them, right? If you take Dogecoin or Bitcoin, they're in this currency aspect that you can buy and sell things, but you can't build new native digital infrastructure with. And so in my services, for the most part, we look for cryptocurrencies that have a use case in the future and are seeing real world adoption. And when it comes to Dogecoin, it's fun. It's something that you can hold as a small part of your portfolio, but I would not bank on this one being the best investment in crypto. I believe there are other cryptos out there. I do think that It was a fun meme point at one point. You know, Elon Musk was talking it up. He was on Saturday Night Live. He mentioned it. And that was kind of peak Dogecoin hysteria. It's not to say that we can't have more rallies in it, but it's going to take a lot more work and innovation on the Dogecoin team to get prices above where it was before, because investors they want to see, you know, more merchants accepting it, or some type of utility case, which we're not seeing in Dogecoin, which we see in other cryptocurrencies.
I think that is so well said, Ian, and you've really put it into perspective. It's always good to hear your take on cryptos. And Winning Investor Nation, if you didn't know, Ian has an entire crypto service dedicated to winning trades that aim to do exactly what he's forecasting for the crypto market. And if you'd like to learn more about his crypto trading service, please click the full icon here over my shoulder to get all those details. So Ian, thank you for sharing perspective. So just one other thing, from cryptos to megatrends. So on where megatrends are concerned, there's been a big shift that's happening with automakers, Ian. They're actually now eliminating low price internal combustion engine cars from their lineup slowly but surely, and replacing them with none other than electric vehicles. This Bloomberg chart titled Death of the Econobox shows how electric vehicles are displacing inexpensive ICE cars that were produced to, quote, only to comply with fuel efficiency laws. So we're seeing a change there. Now, automakers are positioned for more above average revenue as well as profit growth by manufacturing more expensive, pricier electric vehicles. And according to Bloomberg Intelligence, a Ford Motor can, quote, sell a small fraction of Mustang Mach-E's as gasoline-fueled Ford Fusions, while getting a bigger emissions benefit, giving the automaker actually room to sell highly profitable SUVs and pickups, end quote. So we want to couple this with data that we saw in a tweet from Elon Musk.
No relation.
No relation. Freudian slip. Yeah, Elon Musk. That's a good ring. So Elon Musk actually tweeted out yesterday that Tesla has now produced 3 million EVs, and you can see that. You can see that the march of the electric vehicle takeover is well underway, and that the global EV market, which was valued at 163 billion back in 2020, is projected to reach over 800 billion, 824 billion in 2030. So this is just a huge number, and this is just another megatrend that we should always be watching, and not just EVs, but all the components that make an EV, and those type of companies, they're going to move higher too.
Absolutely. And, you know, one thing about investing at places that you want to look to invest in are where there's a change that's happening that's probably going to happen faster than the market anticipates. You know, if you look at the consensus for the number of new EV sales by the end of the decade is like 50%. You know, in my mind, that number is going to be closer to 100%. And I think the thing that a lot of analysts are missing is the fact that the costs for batteries is dropping so quickly that it allows automakers to sell at the same price point, an EV versus internal combustion engine, but have a higher margin. And then they're able to reinvest those profits back into, you know, new battery development. If you look at all the automakers outside of Tesla, they're running, you know, they're developing their own batteries. You've got GM with the Ultium cells. You know, Volkswagen has their investment in QuantumScape and solid state lithium ion batteries. So it really is an arms race right now in the major automakers to come up with the most efficient battery. And when you first looked at estimates for when this crossover point happens, and the crossover point is when the value of an EV becomes cheaper to produce than an internal combustion engine, you know, in initial estimates was like 2026. And I'm thinking about estimates that were way back in 2017. They didn't think it was happening until later in the 2020s. But every year, that estimate has gotten lower and lower. So the crossover now, you know, it's probably going to happen in the next couple of years. And to me, it's just a matter of whether or not these automakers can ramp up production of electric vehicles, because, you know, this is essentially the death knell of the internal combustion engine. Just like 100 years ago, the internal combustion engine replaced the horse, you know, and then in the 1920s, with 1910s and then the 1920s, you know, those 2 decades, you just had a ramp up in automobile production around the country. And And now horses are relegated to farms. Perhaps someday we'll see internal combustion engines, relegated to like their own like separate racetracks for people who want to drive loud cars like you, Amber.
How did you know? That's how I spent a part of my weekend watching drag racing on YouTube.
Did you really?
I did.
That's pretty funny.
Dedicate about 5 minutes to that. So yes, and I'll be there.
Everyone has to have their hobbies, Amber.
Yeah, that's fine. Yeah, it's true. So yeah, well said, Ian. I agree. We're definitely going to see a big transition there going forward, and it will happen soon, more sooner than later.
Right.
So anything else you'd like to cover for this week, Ian? Floor is yours.
I think we've covered a lot. We talked about the market, we discussed crypto, dabbled about EVs, and also, as you mentioned, the stock that we're recommending in the September issue is right in this electric vehicle megatrend. So, if you're looking for a place where you want to put your money to capitalize on the acceleration of electric vehicles, we found a company that is trading at just an amazing value for how big the market could be. And, the company makes money. It's not one of these, sort of ideas where it could make money 5-6 years down the road. It's making money now and has a valuation that historically has been really good place to invest in the stock. So I'm excited to get that out in, I guess, the next 2 weeks from now, right? We're in mid-August already.
It's on its way. That's why it's so important. If you're not yet a subscriber to Ian's Strategic Fortunes newsletter, now's a great time to do that. You can click that bull icon right here over my shoulder to get those details. So good
Awesome.
stuff, Ian. Awesome conversation as per usual. And just everyone remember that you can follow Ian and me on Twitter. Ian is at Invest with Ian, and I am at A Lancaster Guru for a real-time take on market action, on Megatrend developments. It should all be there on Twitter. So Ian, thank you for being here as per usual and sharing your fantastic insights with everyone. We appreciate you so much.
Oh, thanks, Amber.
Oh, you're welcome. And thank you to our wonderful, amazing Winning Investor Nation watchers. We wish you a very good week ahead. And until next time, please take care.